Today we are going to go over the recent changes to the tax calculation regarding the Celsius bankruptcy based on privately held conversations that I've had with tax attorneys close to the case. I've gained additional insights into how they believe that the IRS is going to treat the Celsius bankruptcy and the associated tax implications, and for many it is actually much more favorable than the calculation that we put out previously. Stay tuned. So what changed? Why did we now change our approach from a capital gain or loss methodology now to a different methodology? And well, the reason for that is we now have reason to believe that the IRS is going to view this as a deductible loss under IRC 165C2. So ever since the 2017 Tax Cut and Jobs Acts, personal casualty and theft losses have been disallowed. So you haven't been able to claim a personal casualty or theft loss since the 2017 Tax Cut and Jobs Act. However, under IRC 165C2, this states that transactions that were entered into for profit or for the assumption of profit that are not connected to a trade or business qualify as a deductible loss. So those are exempt. So this is very, very important because the Celsius bankruptcy, everyone that got involved was believing they were going to profit in one way or another. Now, the second piece to this is that crypto is taxed as property, and this was income earning property. So this was income generating property that was lost in this bankruptcy, and we had the transactions were under the assumption of profit. So therefore, this qualifies as IRC 165C2. Now, because it was income producing property, this is going to be a loss reported on Form 4684, and that will ultimately be an itemized deduction on Schedule A, which then you could take that amount against your income. So this is very, very big. Most people were going to have large capital losses, and if they didn't have large capital gains, they wouldn't be able to use those to offset. But now, since it's an itemized deduction, you can just take the full amount and reduce your taxable income essentially by that amount, which is very, very beneficial for most people. Like I said before, if you are in a potential gain situation, so if you had extremely low cost basis on the assets lost and the distributions you got back are in excess of what the cost basis that you lost, then you actually could have income that you need to report as a result of this, this loss. So for those people, it might be a bit less favorable, but for the vast majority of people, those that are able to take this loss, this is actually going to be a better loss. You're going to save a lot more on taxes with this approach. So what we have to do is we are going to take a lot of the same steps to figure out returned Bitcoin and ETH versus liquidated or new Bitcoin and ETH. So here's the scenario that I've written out here. Say we lost 2 Bitcoin, 13 Ethereum, 200 Sol, and 2,800 ADA. And these are the cost basis, the total cost basis for those amounts. Overall, the way that the math shakes out is we have a $65,000 or $65,050 claim based on the petition date prices, which we will link below. And overall, our cost basis is $86,500. Now, we look at the fact pattern of what we got back in 2024, and based on how the distributions work, we got back some amount of Bitcoin, 0.44 Bitcoin at this effective date, at this effective date price, I should say. We got 7.3 Ethereum at this effective date price, 285 shares of stock, Ionic stock at $20 a share. And then in December or late 2024, we got that second distribution of 0.017 Bitcoin at this effective date price. So this is the fact pattern, and the first thing that we need to do is identify what is considered returned Bitcoin and returned Ethereum. So when I look at this, I see that overall we lost 2 Bitcoin, and we got back 0.43 plus a little bit more here. So these two amounts is definitely less than 2 Bitcoin. So I can confidently say that these two amounts are going to be considered returned. Basically, you can have up to 2 Bitcoin returned. So if say we got back 3 Bitcoin, then only 2 of it would be considered returned. The additional 1 Bitcoin would be considered new Bitcoin. Similarly with ETH, we lost 13, we only got back 7.3. Therefore, this 7.3 is considered returned. The remaining ETH is going to be considered liquidated. And so we'll get into that later, but we first need to identify returned Bitcoin and returned ETH. So now that we have the returned Bitcoin and Ethereum amounts, this amount, this 0.45, is just the combination of the initial distribution plus the second distribution. So we know that that whole amount was considered returned. Same with that Ethereum, that 7.3 amount was considered returned. We go to our records, we look at our tax lots, and we need to determine how much cost basis is being returned. So we go and find the 0.45 Bitcoin that was previously held on Celsius. We identify of that 0.45 Bitcoin, this is how much cost basis was attached to it. So you'll note that 0.45 of our 2 Bitcoin held a very small amount of cost basis. So this is a strategy more or less you can use, is make sure that the returned Bitcoin and Ethereum is receiving the low cost basis tax lots so that we can defer those gains. But more or less, this 0.45 Bitcoin had $5,000 in cost basis. This 7.3 Ethereum had $3,500 in cost basis. So then what we have to do is we need to look at the fair value of those returned assets. So you just take this 0.43, multiply it by the effective date price, and we get the fair value of the returned assets at that time. So for the Bitcoin, it's also going to include this December distribution as well. So I'm going to add this amount plus that amount to get 20,477. And then for the Ethereum, the fair value of the returned assets using those effective date prices, is equal to 18,831. So the reason we want to do this is we want to identify how much cost basis needs to be carved out of this amount here, and then how much fair value needs to be carved out of our claim. So I will show you that next. The next step in the calculation is to take a look at the claim value and take out what is actually not recoverable from the claim. So they gave you a claim value based on all the assets you held at the time. For the majority of people, it was marked up 5%, and they essentially allocated out to the different distribution categories: Bitcoin, ETH, stock, proceeds from the sale of illiquid assets, and then there's that last category of likely unrecoverable of 20.8% of your claim is likely just never going to be returned, and the court has actually said, yeah, we're not going to return this. So we're going to carve that out of your claim. So we take the initial claim, which was that 6550, we're going to multiply it by 20.8%. So that gets us to 13,530. This is the portion of your claim that the court has said, yep, you're not getting that back. And we are left with your recoverable claim. Okay, so 51,909. This is the portion of your claim that is actually going to be recoverable from all of those distributions. So this will represent the Bitcoin, the initial ETH, the stock, and then the 6.4% from the sale of illiquid assets, which covers that December distribution of Bitcoin. And now the next step is to now carve out what we had classified as returned, okay? So we had the returned cost basis and returned fair value of those assets, and now essentially we are just carving that out of the calculation and to get what we're left with to get our ultimate loss. So we have our recoverable claim of 51,909. We subtract out what was returned, the fair value of what was returned, which is right here. So we subtract that out, and we are left with 12,631. We do the same thing with cost basis. So overall, we had 86,500 in cost basis, as shown here. And we are pulling out what was considered returned. And so we are left with $78,000 in cost basis. So now we just take the difference, and that is your gain or loss. So if your cost basis is higher, then you would have a loss. If your cost basis was lower, you would have a gain. So this loss is going to go on form 4684. Now, the great thing about this loss is that it is not a capital loss. Most people will have a loss. Some people might have a gain if you had low cost basis, but this is not a capital loss, meaning that you don't need capital gains to fully realize it or otherwise be limited to $3,000 a year. Rather, this will just directly reduce your taxable income in its entirety, not subject to those capital gains that you might or might not have. and overall just recognize the entire loss in 2024. There's no future events that you have to take care of. For future distributions, this method, essentially you are prepaying the tax for it. So it's like a small 3.5% more or less of your claim is expected to be paid in the future. This approach right here, we're basically just going to be taking that into account right now so we can forget about it later. When we get those future distributions, the effective date price will multiply however amount of crypto we get, let's say with some more Bitcoin, times the effective date price. That is going to be your cost basis on that crypto. We've already accounted for it here. And then you should be good to go. So why this strategy is quite a bit better for the majority of people is, like I said, it's not a capital gain or loss, meaning you aren't subject to having capital gains in order to realize those losses. So for a lot of people, a lot of our clients, they're realizing massive losses and they're like, hey, I don't have any capital gains to use, to offset with these losses. What do I do? And they were just going to be stuck using $3,000 of ordinary income, reducing ordinary income each year. But this approach is going to be much, much better for them because they can take that full loss in 2024. If you enjoyed today's video, don't forget to like and make sure to subscribe for the latest crypto tax updates. We do have a course on how to do all of this, as well as an Excel sheet that is going to basically do much of the heavy lifting for you and then show you exactly how to fill out the 4684, push that to the Schedule 1. So if you want help with that, we are selling that course. It is on sale right now for 50% off. So definitely make sure to check it out below.